Alright, let's talk about it. This is the big question everyone is whispering about at car meets, in online forums, and in your own group chats. Is the car market, this wild, unpredictable beast we've been riding for the last 5 years, finally about to crash? We've all seen it. The unbelievable prices, six-figure price tags on used pickup trucks, Toyota Corollas selling for more than they cost new. It's been a bizarre time to be a car enthusiast, or just someone who needs a vehicle to get to work. For years, the market has defied gravity, defied logic, defied common sense. But now the ground feels shaky. The feeling is palpable. You can sense the shift in the air. Market adjustment stickers on new cars look less confident, more desperate. Private sellers who asked insane prices are suddenly willing to negotiate, even dropping prices week after week. It feels like the tide is turning. But is this a full-blown meltdown, a catastrophic price collapse back to 2019 levels? Or is it a much-needed correction, a slow return to sanity? That's what we're going to dig into today. I've been tracking this obsessively, looking at the data, talking to dealers, scrolling endless listings, just like many of you. The truth is, it's incredibly complex. Not one thing, it's a perfect storm bringing us to this inflection point in late 2025. We have lingering supply chain weirdness, sky-high interest rates crushing affordability, and growing buyer fatigue. The easy money and the desperate scramble for any car are fading into the rear view. So, stick with me. We will break down the quirks of the current car market. We'll look at the hard data, prices, inventory levels, sales numbers, and compare to a few years ago. I'll give you my take on what's happening behind the scenes. We'll explore a gentle landing or a full-on nosedive. And most importantly, practical advice for you, buyer, seller, dealer, to navigate these weird times. Let's get into it. Let's start with the big one. Prices, because that's what affects all of us the most. For the last few years, used car values went up, not down. It was completely insane. As of right now, September 2025, we are finally seeing that trend reverse. Manheim Used Vehicle Value Index, think of it like the Dow Jones for used cars, shows wholesale values have dropped 5 months in a row. We're down about 8% from this year's peak. For years, the story of the car market was a story of empty lots. You'd drive by your local Ford dealership, your local Honda dealership, and it would look like they were going out of business. A handful of cars across a sea of asphalt, massive inventory shortage. Automakers couldn't build cars fast enough due to microchip shortages and other supply chain chaos, so demand wildly outstripped supply. But today, in the fall of 2025, the picture is starting to look very different. Those same lots are filling up. According to the latest data from Cox Automotive, the national supply of new vehicles on dealer lots has climbed to over 2.7 million units, a huge increase from under 1 million back in late 2021. In industry terms, we measure days supply, and we're now sitting around a 60-day supply on average, very close to the 60 to 70 that used to be normal and healthy. This isn't uniform. You can find a good selection of domestic pickup trucks, Ram 1500, Ford F-150. Some models sit over a 100-day supply, which is why significant discounts are showing up. Popular hybrid models, Toyota Prius, RAV4 Hybrid, still face waits. Supply is tight, at a 30-day supply or less. Automakers are still struggling to perfectly match production with what buyers want most. As new inventory returns, fewer people are forced into used out of desperation. More used cars are sitting longer. The average turn rate has slowed considerably. Cars that used to sell in 30 days now sit for 45 or even 60. This growing inventory is pushing back against high prices and giving buyers a bit more leverage than they've had in a very long time. Okay, so prices are starting to soften. Inventory is coming back. That should be great news for buyers, right? Well, there's a huge catch. Interest rates. This is the other half of the affordability equation. And right now, it is absolutely brutal. Sticker price gets the headlines. Monthly payment is what people live with. New car loan, about 7.4% today. Used car loan, about 11.5%. Context, 2019, under 4%. Example, $40,000 financed over 60 months. 2019 at 4%. Monthly $737, total interest $4,200. Today at 7.4%, monthly $800, total interest $8,000. That's almost double. Same car price, thousands more paid because of interest. A financial vice squeezing American car buyers, prices still historically high. Financing costs make them unaffordable. Result, many are pushed out, especially lower credit buyers. To truly understand the weirdness now, look back. 2021 through 2023 were unlike anything in auto history. pure scarcity and off-the-charts demand, fueled by stimulus, extremely low interest rates, a shift away from public transit, and less ride-sharing. It was a seller's paradise. New cars were nowhere. Factories shut for lack of a 50-cent chip. Buyers rushed into used, bidding 3-year-old models above new prices. Dealers had all the power and added fees at will. Fast forward to today, September 2025. The primary driver now is affordability, not scarcity. Inventory is near normal. The problem isn't finding a car, it's affording the monthly payment. High inflation drains savings, punishing rates add thousands. Buyer demand is cooling, not for lack of desire, but because budgets are maxed out. This is a shift from a supply-driven crisis to a demand-driven slowdown, the single most important change. Building more cars doesn't help if people can't afford them. Automakers and dealers are pressured to cut prices and offer incentives while facing higher costs. It's a tense standoff between sellers protecting profits and buyers who've hit their limit. Even though dealership lots are fuller, it would be a huge mistake to think the supply chain is completely healed. It's not. It's like a patient out of the hospital who still needs physical therapy. The acute microchip shortage is mostly behind us, but the global automotive supply chain remains fragile and faces new, weird challenges that change which cars get built and how much they cost. One big problem isn't just chips, it's complex EV components, high-voltage batteries, electric motors, sophisticated software. Automakers are investing billions. Building battery plants and sourcing lithium and cobalt takes years. That's why you can find a V8 truck on a lot, while a Toyota Grand Highlander hybrid still has months-long wait lists. The supply chain is lumpy and imbalanced. Geopolitical instability and logistical weirdness. Shipping lane disruptions like Suez and Panama cause delays and higher costs. Labor strikes at ports or suppliers can halt production for weeks, sending ripples across the industry. An automaker might have 99% of the parts, but if the last 1% is stuck on a ship or in a distant factory, the line grinds to a halt. That fragility makes automakers cautious. They aren't flooding the market. Keeping supply slightly tight protects profitability better than overbuilding and discounting. Another reason prices won't collapse overnight. They're holding the line as much as they can. This is the million-dollar question, isn't it? After looking at all the data, softening prices, rising inventory, crushing interest rates, fragile supply chain, are we heading for a 2008-style crash or an orderly cool-down? Everyone wants a simple answer, but the reality is nuanced. Personally, I do not believe we're on the verge of a full-blown crash where values fall off a cliff by 30 or 40%. Instead, we're in a significant, much-needed market correction that will continue for at least the next 12 to 18 months. Why not a crash? First, automakers learned their lesson. They're managing production to keep supply from overwhelming demand, propping up new car prices. Second, the used market is still dealing with the echo of 2020 to 2022 shortages. Millions of cars were never built, creating a permanent hole in late-model supply, helping values avoid a free-fall. That said, if you bought at the peak in 2022, you're likely underwater, owing more than the car is worth. That's tough. I predict used prices fall steadily, probably another 10 to 15% over the next year, a slow, grinding decline. New car prices will be stickier, but incentives, rebates, and dealer discounts become standard again, lowering transactions without slashing MSRPs. The biggest factor to watch: interest rates. If cuts begin in 2026, some buyers return and a floor forms. If rates stay high, downward pressure intensifies. Expect a bumpy, slow descent back toward affordability. For buyers, patience. For the first time in years, you have some power. Time is on your side. With inventory rising and demand falling, prices are headed downward. Do your research, negotiate widely, and get pre-approved before you step on the lot. If you can wait, 2026 likely gets better. For sellers, sell sooner rather than later. Values are sliding. Get multiple quotes and be realistic. If you bought recently, expect a loss. Minimize it by moving fast. For dealers, the era of easy markup profits is over. Compete on price and service. Be transparent. Above all, manage used inventory. The turn rate is everything. Buy smart, price smart, sell fast.